Good afternoon, Facebook community. My name is Jennifer Noreen. I'm with Beyond Brand Collective. I'm here with Bryan Lichau of Cbre Accounting Services. How are you, Bryan?
I am doing fantastic. Thank you. How about you?
I'm good. It feels like a Friday, and I know it's only Tuesday, but it's kind of,
yes,
I don't know, it's all kind of blipping by. So today we wanted to talk about a super relevant topic to the Pacific Northwest, which is real estate investing, tax strategies and tax benefits around real estate investing. And I think the reason that it's very relevant right now is because Tacoma, at least in the last few weeks, has been the fastest closing market in the nation, Tacoma, Washington. South Sound has been an incredibly hot real estate market despite the pandemic. In fact, it has grown. There are more investors in the investor pool in the Pacific Northwest and in the Tacoma area and South Sound specifically than there, I don't know if there ever has been, but it has grown substantially during the pandemic. So while everyone else is kind of downturning and there's a lot of loss of jobs and revenues, the real estate market has actually not only been untouched, but has grown. So if you're an investor or you are thinking about a rental property or buying a vacation rental, this is a really good time to do that in this area. And it's competitive, but it is a good time to look at it. And Bryan actually has some expertise in that. So Bryan, what can you tell us about the tax structures, benefits? If you're talking to a new investor, what do they need to know going into that opportunity?
Yeah, that's, I mean, you nailed it. I mean, the market right now is crazy and the prices are increasing. And so we've got a lot of, we've had a lot of real estate clients already, but yeah, we're starting to see even more coming in, and also with the increases in like vacation rentals and Airbnbs, that type of stuff too. It really presents some interesting scenarios for around tax and how things are treated. So, but yeah, as far as the new investor is concerned, I mean, it's really it's a great opportunity from a excuse me, from a tax standpoint to I mean, oftentimes rental properties and things like that actually operate at a loss from a tax standpoint, just because you've got things like depreciation and it might not be a cash flow loss necessarily, but so I mean, just being able to track all of the expenses and knowing what to look for and knowing what to deduct and everything for an investment property is really important. And there are lots of costs that you wouldn't, like if like for your own home, as a homeowner, you can't deduct certain costs, but as a investment property owner, you can. I mean, things like insurance and utilities, if you pay any utilities like garbage or something like that for your tenants, and things like that would be deductible, whereas on a normal home they would not be. So
I'll show my greenness in this question, but truly green in this topic. But is there ever a scenario where the property revenues are not benefiting an owner, but the tax advantages are? Can that happen the same?
Yeah, definitely. And you can deduct in most cases, even if it's a loss for tax purposes on a regular basis. I mean, you still have equity. You're building equity in that property, and you see the profits more when you sell that property, as opposed to on an ongoing basis. I mean, granted, there's I work with a lot of clients who do really well with their property management, and their own properties and renting their own properties and everything. So I mean, there's there are definitely, it's not always the same, I guess, from a tax standpoint versus your actual investment. You have to look at it as an investment, and so
but you're managing your revenues. You're
Right.
managing your revenues and you're managing your tax situation. You're enjoying some tax benefits and changes, but you're also watching your revenues to make sure your operating costs are not extending your income and just those normal business sorts of things. I mean, a real estate investor runs a set of properties like they do a business, making sure that the improvements they're making and all that are in balance with what they're making.
Absolutely.
What the rent is that they're collecting is in balance. But then you're saying there's also a benefit, and is it tax write-offs? I mean, I know nothing. So what is it that would benefit?
No problem. No problem. And if there is a tax loss, like for that year, so an operating loss, let's just say, you can offset your normal income, your ordinary income, like a W-2 job or business income, anything like that, up to a certain extent in most cases, with the losses that are generated from that rental. I mean, there are limits as income goes up, but for the most part, you can deduct a good chunk of a real estate loss, operating loss throughout the year against normal ordinary income. So that's a definite benefit. But I think the biggest benefit of investment properties is somebody else is paying your mortgage. Essentially, you've got this property and you've got a renter in there that's hopefully taking good care of your property. That's the whole other issue. But you're building equity. You're building. Hopefully, you're taking advantage of the increase in the real estate values and things like that. But and then when you do turn around and sell it, you get capital gains treatment on the gain between what you bought the property for and what you sold it for. So, which are more beneficial than ordinary income tax rates too. So, there's a lot. I mean, there's just so many things that are interwoven into the real estate world, and how tax and depreciation and everything affects it, and so it can definitely be a tangled web to untie, but yeah, I've got lots of experience there. We've got lots of clients that are in that real estate world in one aspect or another, and so that's an area that I enjoy, and always changing. I mean, that's
Do the amount of taxes affect, like I know in some business models, the amount of tax you pay on a product affects how you price your product. So for example, in digital marketing, I only charge sales tax on the product of a website. Other than that, what I do is services. So is it a large enough factor in the property ownership world, what you pay for tax, making sure that your rents are what they need to be based on what your tax situation is? Or is that not necessarily related?
I think it's definitely a factor, but rents are more driven by market, and with real estate, it's so market driven. And then all the property taxes and things like that also factor into that market. However, I'd say it's in your example, I think less of a factor in real estate than it would be in pricing a service or pricing a product. But yeah, it's absolutely a consideration, and you have to consider that when you're making that investment or considering making that investment to make sure that it will make sense for you. And so it's not always the right deal, and it's not always the right situation for everybody to get into. But
so in my learning from a couple of my clients, the table when you're looking at new investment properties is the owner, or the investor. I guess sometimes that could be two people, someone who's going to manage it and someone who's going to invest the dollars, a banker who's supplying the funds, a lender, right? A title person, maybe a real estate person. So is the CPA someone that needs to be at the table when you're having those conversations early on, or at what point do we invite you to the meeting and say, okay, I'm closing on Friday. When is the time to involve you and for educating us and helping us make sure we have all our T's crossed and I's dotted?
Yeah, I think it's more on the evaluation side, and just making sure that the entire tax picture is being considered when you're considering making that investment. When you so if you're closing on Friday, it's probably a little not late, but it's it would make sense to get involved more get more involved earlier in the process. So
can you imagine? I mean, these closing cycles are like 2 days long. Like, I don't know how people are doing their jobs. People must be working a lot of evenings because I mean the market demand and the rapidity of closing, and on the market gone, paperwork done, and I could see how it'd be easy to kind of overlook. Are there things you can overlook that are permanent damage to your deal, or is there always room to adjust? Or
I wouldn't say permanent. I just think that there are certain things to look out for, and I think I'm referring more to the one or two investment properties, not necessarily someone who owns a lot of properties, because they know, I mean, they're much more savvy to what needs to happen. And so those are generally the cases where they're closing with cash, and those are the quick closes, and so I mean, yeah, those are definitely people who know the ins and outs and the benefits of owning those properties. But the one-off investors, I think there's more analysis that goes on prior to that happening, and so it's less instinct, more, or it should be anyways, less instinct and more strategy and planning involved.
So do you think you are more, I mean, obviously helpful at any of those tables, but do you think you would be most helpful to a new investor who was figuring out how to go about the processes and just learning and figuring it out?
Yeah, I think it's a different approach, but yes, there's definitely a planning aspect of that. So like I was saying, it's if you get in front of it and make sure that you understand what you're going to need to do from a tax perspective, and from what you need to report on every year, what happens when you sell it, what happens when you purchase, things like that. Yeah, so someone who isn't as familiar with that, it's going to be important to understand that prior to getting into a deal. Whereas a larger investor and with multiple properties, it's I think the benefit of working with a CPA is more around okay, how are we taking advantage of the multiple property situations throughout each year, and
right.
Can we help them to leverage one property to help the others, and are we capturing everything that we need to? And then in real estate as well, the IRS, it's a professional, like a real estate professional is really a designation within in the IRS, that someone who has multiple properties could be considered a real estate professional, and so they would in turn be able to have different approaches. So they have different limits, their ability to take losses on a regular basis, as opposed to having to wait, really change. And so there's different strategies that would need to be considered as they grow, and so yeah, it's there's just so many moving parts and so many different.
It sounds like it. Is there a limit to how many properties you can own in the state of Washington?
I think so.
Or by state, is that different? Okay.
Not that I'm aware of. Yeah.
Got it. So the sky's the limit. And are you but you're implying that you're taxed differently based on how many you own?
You can be, yeah. If you're considered a real estate professional, it can be considered a business, and you get into passive income versus non-passive income, and so it's yeah, there are definitely different takes and different approaches that need to be considered. Yeah.
What about differences like commercial versus residential, single family home residential versus multifamily? Are the differences just strictly the revenue generated is obviously different, or is there also differences based on the kinds of investments you have?
That's a great question, and really what it comes down to is it's still investment income, and it's so the income itself and things aren't necessarily considered different, but the pieces that go into that, the different deductions, like commercial, there's different depreciation lives for commercial property versus residential property, and so that's really where it gets more in depth, and those differences start to show between those two. But yeah, there are absolutely different problems that commercial property owners deal with, and different than a residential would. So yeah, absolutely.
Yeah, and are you? Is there a licensing that you hold to work with realtors in the state of Washington? Is that just your general CPA license, or is there special indicators that you have?
No, it's just industry experience, really, and I worked for Cbre, which is the world's largest commercial real estate company, and I worked for them for almost 10 years. So I've got a really good understanding of commercial real estate, what goes into it, and
what does Cbre stand for?
Oh, it was a combination. It used to be CB Richard Ellis. It was Coldwell Banker. it was the formation of merging companies throughout the years is where that came from. So yeah. But,
so you're
co-working
familiar.
was a big part of it. Oh yeah.
You've seen a lot of these different kinds of deals, and you are open and wanting to work with investors throughout our region, like Federal Way to Gig Harbor or state of Washington, or?
Yeah, I mean, I think the digital world that we're living in these days allows us to branch out a little bit more, and but yeah, just regionally helps because we're more familiar with the different counties and property taxes and things that need to be addressed in more local areas. But yeah, I'm open to working with really throughout the state. Would make sense. I've got clients in other states as well, so that's not as much of a limitation anymore. But so I got a lot of experience in the state of California as well. So
We've talked a long time actually as an agency, because of the nature of my clients, to do we talked about doing a process, almost a panel session, so that you would be there, we'd have a realtor there, we'd have perhaps a banker or fund provider, maybe a title person. Just who are those players? An attorney, and where do they come in the process? And just because I know that people within that process who have been at it 5-10 years, it's just like old hat. But people who are coming in and trying to understand kind of, where do I start? What do I do first? Who do I hire? Who do I not really need till later? All of that. It might be interesting to do a panel like that and have just a discussion about, what is the order of things, and what are the things that are particular to the South Sound market right now that make it all challenging or awesome, both.
Absolutely. That would be fun. I would love that. I would really enjoy that. That's a great
idea.
Be an
interesting panel, wouldn't it be? Yeah. And I think I can have up to 6 people online, so we should talk about doing that. So anything else you want to share about benefits and tax strategies for the real estate broker or potential real estate broker?
Yeah, I think one area that is really, I'm seeing a lot of uptick in is like vacation rentals and things. So people have a vacation home, and with Airbnb and VRBO, they're really more of an opportunity to rent those spaces out. So
or a 10 by 10 square foot piece of yard in their backyard. I've heard jokes about Pacific Northwest. If you have a place for a tent, you could probably sell that right now. We have such a desperate need for inventory, right?
it is pretty crazy right now.
It is
I haven't heard that extreme, but I believe it. Yeah. So, but doing the right things around those vacation rentals is really important as well, because even if it's a home that we use, but we rent out every once in a while, if there's over 14 days that you rent it out, you have to report that as income. And so
interesting.
That's a nice little tax strategy too. So if people don't necessarily want to rent it out for a longer period, they can rent it for 2 weeks, and that income is essentially tax free.
Just get the in-laws to stay a few more days. Write your check. No, just kidding. But no, that is an interesting thought. I mean, there's a lot of people that have mother-in-law homes and apartments on their, cabins on their properties in this area. It's kind of a trendy thing in Gig Harbor, Fox Island. And I know there's a lot of that business going on. People don't probably realize the tax advantage or benefits. I know that. Interesting thought.
And also the reporting requirements too. That's if they're renting it out and not reporting it. So they're kind of putting themselves in danger there as well from a compliance. But you're right. There's a lot of it happening.
Yep. And probably stipulations on all kinds of things, I'm sure, square footage and how often it's being rented out and all of that. So all right, well, good. I think that this has been good. I think especially for first-time investors and people, and there's a lot of them right now actually entering this market, and just kind of learning that your CPA needs to be at the table early and often, and it sounds like there's some problems you could prevent, and also some benefits you could probably educate them on that they didn't realize that were available. So we'll definitely be inviting you to our panel. I think it's time to do that. and some friends I think that you have in the property management and real estate world would probably join us there. So thanks, Bryan, and thanks for the information. And if you're a new investor or an old timer that needs a CPA, Bryan is located in Federal Way, but he does business everywhere from South King to Lacey. Should I say Lacey, Olympia?
Yeah.
At really Washington State, like Bryan mentioned, it's a digital world now. So if you're, listening to us from out of state, I'm sure that Bryan would be happy to speak with you. So thanks, Bryan, and we'll be speaking again next month. And if you have questions or comments about this topic, please leave them for us or send Bryan a Facebook message. He would love to have a conversation with you. So thanks, Bryan.
Absolutely. Thank you. Always a pleasure.